Now that we've looked at the income statement, I want to take a look at the balance sheet, which is the other main financial report that you'll use in wave accounting. So you can find that right here next to the income statement. So you can see that a balance sheet is comprised of three main categories. The first one being assets, followed by liabilities, and then finally equity. So your assets are all of the things that belong to the business or are controlled by the business, or things that are owed back to the business. So you can see here we have fixed assets, bank accounts, and accounts receivable and cash. Those are the main groupings or categories of assets, although you may have others as well. Liabilities represent all of the debts to your business. So that could be accounts payable, or also any short-term or long-term debts that you might have. And then finally, equity represents the owner's portion of the business, or what the worth of the business in some sense is for the business owner right now. So if you were to think of this structure, imagine your home. So if you are purchasing a home using a mortgage, then your home, the value of your home when you purchased it, would be representative of your asset. It's the value of whatever belongs to you. The mortgage, being the debt, would be your liability, and what's left over, the value of the home minus your mortgage, is your equity, your home equity. The equity is the portion that belongs to you. And that's the same way that it works for businesses here on the balance sheet. Now, one of the cool things about the balance sheet is it does show you the difference between your liabilities and the equity that you own in the business. And the comparison between those two is one of the most common analyses that you'll see people use in the balance sheet or use the balance sheet for. So this comparison between liabilities and equity is often called leverage. So the more liabilities that you have, the more leveraged you are. If you have more liabilities than equity, we often say that you are highly leveraged. We don't typically like to see highly leveraged companies because if you have more debts than you have ownership, you may not have enough to pay off those debts, and it puts your business at a higher risk. So being able to compare the difference between your liabilities and equity tell you a lot about the health of a company. And having very low leverage is favorable as you go out looking for additional investors or lenders to help grow your business. So you want to keep monitoring very closely the comparison between your liabilities and equity. A couple of other things to note with the balance sheet. You can see that we have accounts payable here and accounts receivable up here. These are accrual accounts. They are related and tied back to the invoices and bills that we talked about in earlier videos. If you have chosen not to use invoices and bills and have gone with a cash basis accounting system, then you will not see these accounts on your balance sheet, or should not see them on your balance sheet, as they are strictly accrual accounts. The last thing that I wanted to show you in regards to the balance sheet is this earnings section down here at the bottom. You can see that we have your current year earnings, which on most U.S. balance sheets are called net income, and then your previous year earnings, which is commonly known as retained earnings. So this previous year earnings or retained earnings are all of your net income from prior years that you've left in the business. So as you've earned money year over year, instead of cashing it out as kind of part of your income as a business owner, you've left it in the company's bank accounts to help grow the company year over year. Particularly if you're looking for a lending relationship or you're looking to bring on additional partners, you want to look at this previous year earnings, particularly with lenders. Lenders get very nervous if every year the business owner is taking all of the money out of the business, because it shows that maybe the business owner is not very responsible financially, or that there's a risk that the business does not make enough money to keep both the business and the owner afloat. And so if banks or other financial institutions are seeing that your previous year earnings are constantly zero year after year, then, or do not really increase year over year, then that would be, it wouldn't be a determinant in not getting a loan all by itself, but it's definitely something that they weigh very heavily. So watching your previous year earnings or your retained earnings is also important as you're looking at the balance sheet for your company. So that's kind of an overview of the balance sheet and how it works. Obviously, there's a lot more analysis that could be done, but that's a good introduction to getting you used to looking at a balance sheet and understanding how it functions, and giving you some things you can work with to help understand the health of your business using the balance sheet itself. Subscribe to our YouTube channel and share this video with other entrepreneurs. Doing so will help us to continue creating more videos like this one for you and other Wave users here on The Accounting Lab.